Top of the morning to you. It's Friday, the end of another long and busy week. Good morning, Stel, and good morning to a special guest this morning, Michael Brown. Good morning, lads. How you doing?
Hi. Hello, Michael.
Morning, gents.
Morning, Ryan.
Thank you for having me again.
Yeah, we've got a little bit of turned into a little bit of a substitution because K-Man had a nice surprise yesterday. It's his birthday weekend this weekend, and he was having his son and daughter who live in the UK coming down to him. And last night, got a phone call from his daughter saying that the trains had been cancelled at Southampton. Can he drive the, I think it's about 50, 60 miles to pick her up? And she said, bring mum as well. So they both jumped in the car, turned up, and she walked out the station, and so did his son and daughter-in-law from Tokyo, who they haven't seen for 4 years. So a very big surprise. No doubt he was blubbering away. So he's off today and likely off on Monday. So quite apt that Michael was coming in anyway. And we're going to throw everything to do with Japan at you this morning, Michael. So I hope you're ready.
Oh, good. I'm really looking forward to that. Well, hopefully I'm a more than able and adequate substitute for him this morning.
I'm sure you will. I'm sure you will be. How you doing, Stel? You all right?
Yeah, all good. It's Friday, and it's been a long week. But yeah, all good. All good.
Yeah. It's good when it's like this, though. Good volatility. That's what we like. Don't
Yes,
like it when it's a crap week of hard work and things going wrong.
well,
So
I personally don't like when Eurodollar takes my stops, but yeah, volatility is nice.
Yeah, we never like that. We never like that. Right, so let's get cracking in to what's going on. Then we'll have a chat with Stel Michael in a bit. Starting with China, as we often do, Vice Premier Sun said China's COVID infections are now on a low level. Take that with the usual pinch of salt. At Davos, Chinese and Australian officials met during a small WTO ministerial meeting, report Xinhua. So maybe some further easings of problems there, and maybe we're going to get some more news on the lines of China re-importing Aussie coal. So if that does happen, that's going to be potentially a further boost for Australia and the Aussie dollar. Apparently, the US Treasury team is going to visit China in February, and they're going to start preparing for that visit. So again, more lines towards easing of tensions there. See what that brings. Overnight, China kept its LPR rates unchanged. The loan prime rate, 1 year LPR kept at 3.65%, 5 year at 4.30%. We did hear from Chinese press earlier this week that they may be looking at further easing the PBOC, probably in interest rates or the RRR cut. But at the moment, they're keeping some of their shorter term rates unchanged for now. Over to the data. The big data point overnight was one thing I've been waiting for all week, turned into a bit of a wet lettuce in terms of market moves. But Japanese CPI, the core number, rose at the fastest annual pace since December 1981. Came in bang on expectations at 4%. So did the national CPI and some of the other measures, the ex-food numbers, ex-food and energy numbers that they measure over there, all came in as per expectations. There was very little move in the yen. I think it went about 8 points, 8 pips, because I was up and watching it as with the K-Man. So no real trade to grab on that one. But what we have seen this morning is it rallying. It actually managed to get a little dip overnight or yesterday into 127s, but that CPI number couldn't get anywhere down there again, and we've seen a rally since. As I mentioned yesterday, you're here and on Face, I've been thinking that we've potentially got a bottom coming in play, and the fact that we didn't get down there on the CPI numbers has me thinking that I'm right with that thinking, and that we're potentially going to see some upside from here on out, at least for the short term. So it's made a little bit of a bounce there. We're going to switch quickly into the Fed orbit next week. All the Fed members go into blackout, so no more waffling from those clowns as of tomorrow, and then it's nice and quiet until the FOMC at the end of January. Guys, what do you make of that reaction to the CPI? You know, highest number since 1981, big news, but yen isn't taking effect of it, really, is it?
Yeah, it is a high print. I guess it has to do with what the market was expecting, and also, you know, this move has been really, really odd because there was a big reversal. Sorry, let me just hang up on the wife. That's good. I'm going to pay the price for that later. So we had that this big reversal, which kind of tells me that positioning may have been quite heavily one way. I mean, I don't know what to make of this. It's you know, given inflation rising, I would have expected the BOJ to be a little bit more aggressive, but they're not. I think that the turn in policy is coming, but certainly it's not is not coming as fast as maybe the market expected, or you know, maybe logic dictates. So I really don't know what to make of the yen and the BOJ. I'm stumped, and every time you ask me about the yen, I'm like, yeah, I don't know. You can ask me about other currencies. The yen just boggles the mind for me.
Okay, what about the Polish zloty? What's that doing, mate?
Oh, that's easy. Okay, so you want to be an
Michael, what do you make of these yen moves? Have we priced as much as we need to for the moment, do you think?
Well, I'm glad you're sending me the yen question and not the Polish zloty question, because I would not have any idea where to start with that one. Yeah, I think the yen's an interesting one at the minute. Everyone is expecting this big shift in policy to come, but it seems that the general rule of thumb with the BOJ over the last kind of month, 2-3 months probably, is when everyone expects them to move, they don't, and when nobody expects them to move, they will, because the decision to expand the trading band for yield curve control in December was pretty much a total shock to everyone. No one was expecting it at all. This time around, there's all this speculation in the market that they're going to do something, and then they decide to stand pat. I think the yen is probably pretty well priced at the minute, between kind of 128 and 132. If you look at dollar yen, the market prices in a rate hike by the end of the year in H2, which seems reasonable to me. And I don't think the BOJ are really going to want to do anything until the new governor is in place. I think Kuroda he's got 2 meetings to go. I think he's going to play those 2 out with a relatively straight bat, and then after that we should get things a little bit more interesting as we move into the second half of the year.
Yeah, I think I agree with that, mate. I'm certainly, at least short term, not as bearish. I'm still in short, but I'm thinking I may take some more off the table, because I do think we can see a possible rally here, not in a straight line, but maybe we creep up to that 132s, 133s area, maybe even up to that 134, 4.5 point, and perhaps see a bit of consolidation going sideways. But as I said, you know, we're going to be in the Fed orbit as well. That's going to be swinging the dollar side of things. We'll see if they're more hawkish, more forceful, fighting against the loosening financial conditions that we've been seeing, and then we'll take it from there on out.
Yeah,
so anyway,
the other point. Oh, sorry, Ryan. I was going to say the other point I make on the yen is that actually a big part of this move in terms of pricing in more hawkish expectations from the BOJ has already happened in the fourth quarter of last year, when we had that big run down from 152 or whatever it was down to the 130s. So, you know, a decent part of the move and those positions have already been put on, which is something else to bear in mind when considering where we might head next.
Yeah, absolutely. And we talked about this with the Fed, you know, and we saw dollar yen rising a lot to do with the Fed and yields. And you get to a point, you get to a level, and you think, well, what, you know, the market isn't just going to keep going up in a straight line. Everyone knows where the Fed is at. What's it now going to take to give dollar that extra boost? What does the Fed have to do? Because the market gets to a point, it's priced something. Now you need something extra. So we need confirmation from the Bank of Japan, from the new governor, from whatever the data, that there is a closer chance of the Bank of Japan changing policy. Everyone thinks they're going to do it. No one knows when. So now the pricing is a bit more balanced, I feel, in this one. But we watch it over the months ahead. As you well know, nothing happens overnight. We keep watching, waiting, and trading what the price action tells us. So yeah, let's shift over to. I know this is a favourite of Michael's. BOE's Bailey. He says a long but shallow recession is coming for the UK. The fall in December inflation is the beginning of a sign that a corner has been turned. Most likely outcome is inflation will fall quite rapidly this year, probably starting in the late spring. There is more optimism now that we are going to get through the next year with an easier path for inflation, and we don't target a particular peak for rates. Getting close to a victory lap there from the Bank of England. I don't think they're going to see inflation dropping even as much as they think. I've been saying it for a while, but yeah, he's getting a bit more optimistic. But there's not much optimism in the UK retail sector, according to a GfK survey. Apparently, the UK consumer mood has slid back to near 50-year lows. Oh, it's the end of the world again today in the UK. That may be borne out by what we saw in UK retail sales this morning, which for December didn't paint an overly pretty picture. Where are we? Lost it. There we go. So retail sales down 1% in December versus 0.5% expected on the upside. Year on year down 5.8% worse than expected. Core sales down 6.1% year on year, 1.1% month on month. So a bit like the US yesterday, retail sales over the holiday period, one of the stronger periods, not playing ball and painting a bit of a dour picture. But as I mentioned, yeah, go on, Michael. You got.
I was going to say, just what's interesting on those retail sales figures is, as you say, they don't paint a very good picture at all. And obviously, December is absolutely key for retailers with Christmas and all the rest of it. But one thing that they do show very, very well and very, very clearly is how inflation is having an impact. If you dig into the numbers, which I was sad enough to do because I had nothing else to do on the train into work this morning, retail sales by volume, which is what we all look at and what you've got on the chart there, on the calendar there, sorry, the volume of sales was down 5.8% year on year, basically 6%. But if you actually look at the value of sales, so the amount that people are spending in the shops, that was up by just shy of 4% on the year. So people are spending 4% more than they were in December last year and getting 6% less for it. And when you sort of contextualize that, it's very, very easy to see what the impact of having a 10.5% inflation rate is on the economy and on consumer spending.
Yeah, that's the exact point. It's something that Steve often likes to pull out, talking about inflation and retail sales. And it's something that the US bucked the trend really with that as inflation was rising. Because remember, it peaked last July, I think. We're talking about peaking, whether it's peaked in these conversations now, but it peaked last July somewhat. And yet we were still seeing positive retail sales, even while inflation was biting. So yeah, consumers are spending more to stand still, if you like, or not spending more and getting less value. But market's going to move on whether numbers are positive or negative, and if it sees a run of negative numbers, market's going to price accordingly, things like the Bank of England rates and all that sort of thing. So yeah, inflation is one thing, negative numbers are another thing. Right, let's move on to Her Majesty over at the Sunbed Towers. ECB's Lagarde yesterday, she was asked why the ECB is failing to convince the market that it's determined to raise rates and further at a fast pace. And her response to that was, I would advise market participants to revise their positions. So Her Majesty coming out, like we've heard from others, pretty strong against what we've heard this week regarding the possibility of the ECB maybe not going as strong on hikes as we were led to believe. That message is being reinforced pretty strongly. As we said yesterday, it would do. The ECB are not a central bank that will let things like financial conditions fall below where they say rates are going to go. Now, we've also got the ECB minutes, and a large number of members initially expressed a preference for increasing the key rate by 75 points. and saying that raising rates by less than 75 points would have sent the wrong message and risked being perceived as inconsistent with the 2% inflation target. Obviously, most of them agreed that 50 pips was the way forward, but still the hawks are pushing within that. S&B's Jordan has been giving us some fun and games in the Swissy. He said some tightening is probably in the cards. That was yesterday, and if the franc is too strong, he won't hesitate to act, but it's not the time to discuss loosening monetary policy, and that they have to focus on core inflation. His vice chair, if I get the name right, Schlegel, said that the further interest rate hikes are not ruled out, but it's hard to determine at what level the terminal interest rate lies. And then this morning, Jordan was out again, and he dropped a little market bomb for some players by saying that they are now able to sell some of their Forex reserves again. Now, perhaps strangely, we saw this little pop in Swiss pairs. And as one person who I know on another chat pointed out, that may be the wrong market reaction, because if they are going to sell FX reserves, that means selling other currencies and buying Swissy, which is not what that move is we've seen now. But the market may be so focused on the fact that when the S&B intervenes, it's to sell their own currency. They've taken that as a natural reaction. I am in a small short, Euro Swiss at 99.76 on the back of that, potentially the market being wrong, but it's not doing too much at the moment. And as we know, the market can remain far longer than we can remain solvent. So I'm going to keep an eye on that one. What did you make of that comment, guys? Being able to sell FX reserves again and the Swissy selling off. Is it the right reaction? Am I wrong?
I'll let Michael answer.
I think we were both waiting for each other there. I think the market has got that wrong, to be honest with you. As you say, it's kind of totally counterintuitive to the move that you would expect on that headline. Then now, as you say, the market can get these things wrong and stay wrong for a lot longer than you can hold a position. But certainly at a glance, I must admit I haven't actually read the remarks in full and dug into it in any depth. But at a glance, my initial read on that would be, you know, the market is reacted in the wrong direction to that. It's mispriced and should come back as the day progresses.
Cool, thanks for that. That makes me feel a bit more warm and fuzzy about holding my position.
Well, as they say, you know, great minds think alike, or fools seldom differ. I guess you can choose whichever one of those applies.
Okay,
yeah, I must admit I was a bit confused as well by the market reaction. I mean, it doesn't make too much sense, but yeah, I'm going to have to echo Michael's view. I don't understand why this has moved the way it has. So yeah, I'm not much help.
Oh, well, that's fine. All opinions matter, mate, and we shall see what happens with that anyway. Right, let's shift over to the good old US of A. Fed's Collins was out yesterday saying policy rate needs to rise to likely just above 5%. Then we need to hold them there for some time, and but repeated that it's appropriate to slow the pace of rate hikes, particularly with risks now more two-sided. Fed's Brainard is often seen as one of the big wigs there, obviously. So her comments often taken quite with a big view. She said it will take time to resolve to get high inflation back to the 2% target. Policy will need to be sufficiently restrictive for some time. The recent downshift in the pace of hikes allows the Fed to assess more data as it moves policy to a sufficiently restrictive level. She does see signs or tentative signs that the labour demand is cooling. And a bit of a comment here about the balance sheet runoff, saying that it's equivalent to a 50 or 75 BP of tightening. Now, this may be one of the Fed heads or the Fed moving into the accounting smoke and mirrors. If they wanted to slow hikes, actual hikes, before hitting their 5% ceiling, they could lean on this excuse that, oh, we've got 50 and 75 pips of hikes and of tightening in there from the balance sheet runoff. So just keep an eye on that one. As I say, might be a bit of a smoke and mirrors accounting trick going on there for rates. Feds Williams says the Fed needs more rate rises to cool inflation. Now, just back on something we've been speaking about previously, the good old US debt ceiling. The US banged its head on that ceiling yesterday, and as such, Treasury Secretary Yellen began using extraordinary debt limit measures as of yesterday. Now, sounds like a big, huge headline. What it basically means is she's hit the countdown clock on the US government, Congress, the houses to get themselves round the negotiating table. These extraordinary debt measures are now in place until June the 5th, unless something gets sorted out before then. But now it is a bit of a drawing a final line in the sand that if we get to June 5th and there's been no resolution, we will start seeing government shutdowns and everything else that goes with it. So, as I say, it's a bit of a countdown clock for the powers that be to get negotiating. What's likely to happen is we're going to get probably a few months of the usual chest beating and threats, and we're not going to do what they say type stuff going on until it gets down to the 11th hour when the shit's just about to hit the fan and they'll finally knock something together. But what does this mean in the interim? It doesn't mean the US are going to stop borrowing and not going to be able to fund their obligations or anything like that. It just means they're going to get up to some accounting tricks, shifting money around between different governmental departments and programs, things like postal pension in reinvestments and the various things like the Exchange Stabilization Fund, all these different programs that the government has running that they put money into. They're going to start shifting stuff around so they can meet their obligations through to this June 5th date. So nothing initially to worry about right now. As I say, what the market will pay attention to is if we get down to the 11th hour and it's still a big bum fight with no signs of resolution, then the market may get a little bit anxious. But other than that, the clock is ticking. Finally, just to go over a bit of the data that we had yesterday, just to bring us all up to speed. Building permits and housing starts finishing off the year, bit of a meh number there, or meh, nothing of too much of note there. Slight down in permits, slight down slight up in housing starts on those numbers there, so nothing really to write home about. Jobless claims, a lot of eyes were on that yesterday as to whether there's going to be something funky going on. There was. It dropped to 190k from 205k. Perhaps market was expecting something on the other side for jobless claims to go higher. It can be a bit of a funky time of year for these weekly data numbers, just reporting straight after the new year and holiday period. So don't take too much into that. We'll see if how the trend develops further into the new year. Philly Fed manufacturing, not as bad as expected. Expected to drop to -11, came in at -8.9. And the other components saw a bit of weakness, but not as bad as last month, which might be a bit comforting considering what we saw for the Empire State earlier this week, which completely fell out of bed and out the window and down 8 flights of stairs. So that may highlight a bit of weather impact, because obviously the Empire is for the New York State. This is for a completely different area. So maybe a bit of a weather issue in there is going to screw up the numbers, because the Philly, as I say, wasn't as bad as what we saw from the Empire. Right, that's it from the headline front. Unless you guys have got anything you want to, hand grenade you want to throw into the mix?
Just one thing I want to mention. We were talking yesterday about how we could be going back to the old normal, where deteriorating economic data means lower stock prices, lower equity levels, and this is mainly because when you have companies laying off loads of people and there's less disposable income for individuals, and less buying going out, so basically less earnings for the companies. And look, we had Google announcing 6% headcount cut, which is not a small number, right? So we have these monsters of companies like Microsoft yesterday, I think, and Google and Meta and all these, colossal companies reducing headcounts. This is going to be, excuse me, a headwind for equities, and it would be nice if we go back to the old normal where everything made sense. But just something to remind ourselves that the markets have been conditioned for a decade now that, bad data means central banks coming in, buying everything, throwing the kitchen sink at it. So that means that equity indices go higher. Well, I don't think that's going to be the case, at least not in the short term, at least not until we really do see a major turnaround from the central banks. And I don't think it's coming yet because, we've heard Lagarde on the ECB, Ren as well, saying we're going to keep hiking. We're going to be, we keep fighting inflation. And also the Fed, they keep saying that to us, even though the market doesn't believe them. And we're inverting we have a very inverted, excuse me, I don't know what's wrong with my throat. We have very inverted yield curve. They're still telling us that this is what they're going to do. So, I just think that we should put all this in context, and I think the risk is still that we see a move lower in risk assets. And I'm just using, the news that Google is firing more people, laying off people as a point.
Yeah.
I think that's a great point, and I think just to extend that a little bit further, I think it's part of the fact that the new economy post-COVID that we're dealing with is one where inflation will probably be between 2 and 4% rather than 0 and 2%, and rates will therefore be between, say, 3 and 5% rather than 0 and 2%. And in that environment, you aren't going to have central banks simply riding to the rescue every time we see 10% downside in the front month S&P future. The central bank put, as it was, is pretty much dead and buried at this point, I think. I think it is going to be a case of, as we move forwards, markets are going to wake up and smell the coffee and realize that bad news is actually bad news, particularly when monetary policy is going to remain much, much tighter in the next 3 or 4 years than it was in the previous 10.
Yep, absolutely agree.
Yep, great points, guys. Right, so let's have a look at a few prices. Well, firstly, I want to point out that I've been speaking about bank forecasts earlier this week and how I don't believe they're worth the paper they're written on. Well, BNP on Wednesday initiated a short dollar-yen position targeting 120. They did it round about that line there, around about 128. So off to a good start. They didn't want to short it at any time while it was falling from 150. But they decided they wanted to short it some, 2,500 pips later, right on the lows. So once again, if you like bank forecasts, take them with a pinch of salt. But I definitely wouldn't trade on the back of them unless you want to counter trade them. But anyway, that's my thoughts on forecasts. Mark, you don't like making forecasts, do you?
I think it's quite amusing, actually. I think we were talking about bank forecasts earlier in the week as well, Ryan, and the fact that the consensus for this year was, it lasted about 15 days or something stupid. The consensus was very much, long dollar will be long dollar, equities are going to come a bit lower in the first half of the year, short the Eurozone, short the UK because they're going into recession. We're not even through January yet, and I've seen at least 4, maybe 5 now major investment banks literally tear those forecasts up and do a complete U-turn. In fact, forecasting is hard, trading is hard. We're not going to get everything right all the time, and I don't want to drag people too much. But I got a very, very long note from ING at the start of this week. I think it was on Tuesday. And it was literally tearing up their entire forecast. And I'm now going to pop myself on mute for a moment because the office are being very kind and deciding to test our fire alarm. So apologies for that. You probably don't want to hear a siren and an alarm. So I'll just silence myself for a moment.
Yeah, no problem. Okay, right, we'll play some music until he's back then, I think, or get Leandro in to play his guitar.
I remember the fire alarm tests when I was at Merrill. Everybody would go down, there's as an area where everybody's supposed to gather, except 30, 40 traders. We would not leave the desks. They would have to take us by force.
I remember those days well, mate. I remember those days well. Always ignore the fire alarms unless there's smoke coming out your ears.
Exactly.
Anyway, I've spoken about dollar yen. I think, as I say, just to reiterate quickly, I think we have found a potential bottom, short term or otherwise, down here, and I expect to see some upside and maybe a bit of a consolidation phase beginning now. We just need to define further what the upside levels are going to be: 131.5, or this zone here, 132s, 33s, and up at these 134s.
I want to sell against that trend line if we get there.
Yeah, you're looking at that trend line there, are you?
Yeah, 132-ish.
Good place at any. If you've been short this pair, long yen for a while, this may be a moment where you want to take stock of your position, just to do a bit of management. Make sure you don't get kicked offside on any sort of rally before it then hopefully starts coming back again. Now in other pairs, it's a pretty similar story. Oh, you're back, are you? Cool.
I'm back. You can stop playing your music now, or whatever it was you were doing.
Did you put out the fire?
Yeah. Just come back after putting that out. Just man of many talents over here.
Pause it. Another bank forecast blowing up.
Oh man.
Oh, it's Friday. We can have some fun on a Friday. Right. So euro dollar not doing an awful lot. It's pinging between the lines. Moving less than other pairs at the moment. Now, what that does, that really keeps this top side level in play, because if buyers are given up at this level in droves, if they've really given up trying to crack this level, we would see it much lower, probably down to the low 107s. So we're still in with a shout of potentially getting a break up here. What's going to cause that, I don't know. Maybe it'll be the FOMC if we last that long before breaking. I'm still interested in looking at a break trade. I may go with another small try if we get above here, or I may just sit back, let it break, and see if we get a move back and a confirmation of the break by coming back and finding support here and building support off the level. Then we get the push up, the proper push up. Aussie dollar, just a quick one here. We've got a large expiry today, just under 4 billion rolling off at 69, the big figure, which pretty much explains the price action we saw yesterday, which saw it keep gyrating, 30, 25, 30 pips below, a few pips above, and pretty much any time you looked at it, it was somewhere close to 69. So that was maybe some last hedging around that option yesterday. We have pulled away this morning, but it's not straying too far. I've spoken about option expiries before. They really have to tick a lot of boxes for the potential for a trade. We don't know what the options are made up of. We don't know if it's one player or 100 players. So there's lots of different things to look at. But when you see price action around a big level, when there's a big expiry, then it piques my interest, and I think, well, maybe there's a possibility of a trade. So what I'm looking for here on this expiry is whether Aussie dollar goes out of sync with what other pairs are doing. Let's say, for example, dollar gets heavily sold off, euro dollar breaks 109, cable gets up to 124.5, 125, dollar CAD dumps off, but Aussie dollar is still knocking around 69.30. That's going to be an indication to me that the option is having an effect on the price, because Aussie dollar is not following whatever all the other dollar pairs are doing. That's when I look for a trade. If that's the situation into the expiry, I'm going to think once that expires, Aussie dollar is going to play a bit of catch up. Now that can be on both sides. If euro dollar was down at 105 and cable was crumbling, but Aussie was still holding there again. So it's a two-way situation you need to look at if you're trading something like this. It may come to nothing, but price action is what I watch all day long, and this may be something that shows up. Euro sterling, mentioned earlier in the week, if it can't crack up above here, then maybe some of the buyers are going to give up, get out, think that they're not going to get a break, and we see a pullback, and a pullback we got. I was looking here initially for maybe a long into the 87, 70, 80 area. I didn't like the price action. I left it alone. I was looking more towards this zone to maybe pick some up. I was a bit greedy and I missed it as well. I didn't have my eye on the ball, so I haven't done anything down here, and we've seen a decent bounce. However, it can't get and hold above this old support resistance area, 87, 70, 80. So while it can't break that, it's going to keep the upside limited for now, and maybe we get another test down here. If we do get a quick return, I might be less inclined to go as big a position in trying that support area down there, because I don't like a level that a price moves away from and comes back pretty quickly. Still, you had a bit of a stormer getting out of your long earlier this week. You picked
in euro pound, yeah. That was nice. That was nice, although not as nice as K's exit. I think he got out at 88.90. I got out at 88.30, 35. I need to check. But the reason why I got out was a little bit of a impulse decision, because we were starting to get rumors about a final resolution on the Brexit. Brexit, that word brings back memories on the Brexit differences that are still there. So I kind of got a little bit worried, even though I am bullish the euro, simply because of policy divergence. I think the ECB, or at least they're telling us that they're still hawkish and they're going to be doing 50s, more 50s coming. And the Bank of England, we had two members voting for unchanged last time. So I see a divergence there, and I think it's probably going to continue. So that kind of, but this, I am bullish in Europe, but I was a little bit scared of a potential pullback due to these headlines. Well, we did get the pullback. I don't know if it was due to these headlines or not, but we did get that, and I was happy to get out. But this has been a very big move. I've been saying for months the range is 83 to 90. And I've been saying we're going to 90 from what, the 83s, 84s. And we gradually almost got there. I don't know what I'm going to do with euro pound now. I don't want to buy it here. I don't want to sell it here. If we get close to 90, I think I'm going to definitely consider selling some. But at the moment, even though I am bullish the euro, price action is not yet telling me that I should be getting back in. So sit and wait for me at the moment.
Yeah, I agree with that, mate. I think it's a bit in the middle here.
No man's land.
Maybe if there's a final confirmation of some Brexit stuff, we get a decent dip in there. I certainly can't see it going all the way back down to the 82s, 83s, that sort of area. I'm keeping my little piece that I put it on last ECB meeting. If you remember, when we was right in the middle of face. Which, funny enough, because you remember I was buying it down here as well, and I ran it all the way up to 86s, and then I got out of it over the summer because it was doing nothing, and I didn't want to just pay the carry cost. I think I got out at 86.30, and I got the ECB bit back in at 86.24, so I managed to make myself 6 pips better off over about 6 months. But yeah, I agree with you. I think 87s is if you want to play a little short-term trade and maybe try and hold on to a bit, that's probably the level you're going to be looking at. But I think anything lower than that, down to this zone, 86s, maybe even down to these lows of the push, is potentially going to be an absolute gift. Obviously, that's not trading advice. That's just my opinion. Michael, I know you watch this one quite significantly. What do you make of it?
It's an interesting one, isn't it? I mean, obviously, I look at things as you know from a kind of more macro viewpoint, and I think as Stelios mentioned, the divergence between the two monetary policy outlooks here is huge. Probably bigger than at any time in recent history. At the very least, you've got the Bank of England 50 basis points is pretty much locked in for the Fed meeting, I think, after the inflation data and all the rest of it that we've had recently. 50 basis points in a fortnight is pretty much guaranteed. But after that, we might get 25 in March, but even that is looking a little bit doubtful at the moment. And then on the flip side of that, you've got the ECB, who are being far more hawkish, 50 basis points in Feb, 50 basis points in March, doing their best to very, very quickly row back on these sources stories that we had out earlier in the week that guidance might not be valid. We've heard from a plethora of speakers since then who have tried to push back on those reports. So I think euro sterling will probably continue to head higher from here on in, just based on that alone.
Yeah, that makes a lot of sense. I want to be a long euro pound. I'm just waiting for a little bit more price action and see if we have reached some kind of a medium term bottom here. But yeah, I agree with that 100%.
Yeah, definitely. But we've got to, you and me, diverge a bit here, Michael. I think because I think the BOE are going to have to hike up to near 5% before they could take their foot off the gas. And I think you're in the camp that. I think you actually believe what Bailey's saying, that they're maybe not going to get up as high as that. They're going to get to maybe 4% or that sort of area.
Yeah, I just think in terms of, so with the BOE, there's a big difference in my mind between what I think they will do and what I think they should do. What I think they should do is along the lines of what you just suggested, and actually they should have probably gone at a much more rapid and aggressive pace last year when they were raising rates, rather than waiting so long to step up to larger increments. But I think just looking at recent history from the BOE in terms of their track record when making policy changes, and also if you look closely at the press conferences and recent remarks, they're all flagging downside economic risks, particularly to growth and especially fragilities in the housing market. And I just think the BOE are almost going to look for any excuse, any reason, no matter how kind of flaky and insignificant it may be, to take on a more cautious approach and bring the tightening cycle to an end sooner rather than later. And actually, it won't take a lot to tip the balance in that favor. You already had two of the MPC voting to keep rates unchanged at the last meeting of 2022 in December. It's not a huge stretch to see another three joining that camp within the next 2 to 3 months. Now, I'm not saying that's what I think they should do, but I think that's what they will do. And I think that's an important point more broadly, is to, when you're taking a view on the market, when you're taking a position in the market, it's important to trade what's in front of you, not what you think should be in front of you, if that makes sense.
No, as always, it's key. Price action is king, no matter which way you look at it. We can have all the thoughts and opinions in the world. The price is going to do what the price is going to do. So you never marry your own opinion. That's one thing all traders should learn. Right, quickly, I just want to bring you guys and girls on to one of the reasons Michael is here. For those that
certainly not for my pretty face, I can assure you of that.
I don't know. I think we've all been up the ugly tree and fallen out a few times on this show. But I wouldn't say that. You've got youth on your side, which is one thing. So
I didn't want to go there.
Yeah, trust us, it's a downhill slope. It gets quicker the older you get. I know that. I last year, but anyway, you've got youth on your side for now. So the reason why, one of the reasons why I've got Michael over here is because he has moved to Pepperstone. He is now over at Pepperstone. And he's going to be launching a trade-off. Now, some of you folks may know this as a regular that Blake's on with Chris Weston, a weekly show that they do, very successful. I know a lot of the guys in the ForexAnalytix platform watch this. Well, Michael's been given free reign to start his own show. And fortunately, or unfortunately, depending on your viewpoint, he's asked me to come and be his co-host. So this is kicking off from next week, the first show. We did a little bit of this was a tester we did a couple of weeks ago. just to see how the format would all work. And apparently, the guys at your end thought it was good enough just to put out on its own. So hopefully, that's a taste of things to come.
Michael, you could have gone for Kim Kardashian. You got Baldy here. I mean, come on.
I'm sure we can get Ryan in a sort of long, dark-haired wig, and that would be close enough, wouldn't it?
Yeah, hey, actually, you're right.
It's your show. You don't want to bet what I can turn up looking like. So be careful what you wish for. But anyway, this is kicking off on Monday. Just a weekly show. So if you want to subscribe to that, you can do. There's a registration. I'll put the registration link in the chat there for our folks. You can register to receive that. I think it comes in your inbox, doesn't it? You send it out when it's posted online.
Yeah, that's right. That's right. Yeah, so we'll be getting cracking with that on Monday afternoon. As you say, the dry run went very, very well. We've worked together numerous times on this sort of thing in the past, so looking forward to getting going properly with this, and hopefully, and I'm sure we will, beating Blake and Westy when it comes to not only a hit rate on trading ideas, but also on view count as well. I feel like Westy's going to offer me a wager on that at some point. So yeah, I'm confident not only will produce some good market content to keep you all informed and on top of what's going on and give you a bit of food for thought, but also beat the Aussies as well, which is always nice bonus.
Yeah, always good to beat the Aussies. You got to watch that Blake though. He's a master at these things, all these, interviews and videos, isn't he? Still, absolute master.
Oh yeah,
the stuff. So yeah, you can take on Westy, but I don't think I'll be taking on Blake just yet. Give it a couple of months.
But anyway, it should be good.
Yeah, if you want to sign up for that, you can receive that. So it's going to be a weekly thing, and yeah, it should be a lot of fun doing it in someone else's backyard. I can get up to mischief in your backyard rather than in mine. Anyway, still, I don't know if you got any thoughts on metals just at the moment.
Well, my view is unchanged. Silver is the one I've been following a lot closer over the past years, and frankly, my levels are the same. So 24.50 on a daily close or above. I reinstate half my long, which I took out roughly at these levels a couple of weeks ago. I'm still keeping my other half long from 2050, which is doing very nicely. I really, really want to be very, very long, but this sideways consolidation could be a short-term reversal, especially if we do see yields rising. And the 10-year US has been at I'm actually writing a blog post about this right now. 10-year US has seen confluence of support as 340, and I think we could be due for a bounce, and if the 10-year yield bounces, I think the targets are around first target around 360-ish, and then we could challenge the highs at 389. So if that materializes, yeah, you can say goodbye to any short-term rally in metals. That's why I'm still holding my horses and waiting for that. But having said all that, if yields don't rise and we see metals breaking out to the upside, and by metals I mean silver, because gold is already doing pretty well. It's leading the charge, but silver and platinum are not following. So if and when we see silver breaking out, I'm definitely going to get in, maybe buy a bit more platinum as well, just try to diversify a little bit. But silver is the main one I'm looking at. And I have to admit, silver has been very good to me over the past few years. And I'm not advocating that people trade like I do. I've been outlining what I do quite regularly on these webinars, but my horizon is a lot longer than most people, and also my tolerance is a lot longer. And I'll just give an example, which I've said before. My last big position in silver was getting long in the 15.5s around 2018, and well, when COVID came, that was not good, because we got to like high 11s or something like that. But then I trade silver with very low leverage, so my stops are very generous, and in some occasions I don't have a stop. I know I'm not advocating people do that, but in any case, after COVID, I unloaded at just over 25, so that was a nice trade, but it took 2 years or 3 years almost. So this is the way I do it. I slowly scale in, very low leverage, and I'm very patient with these trades, but I want to maximize my entry levels because being in a big drawdown is difficult to handle, as you can imagine. But hopefully we'll get the timing right on this one as well, and see how that goes.
Yeah, definitely, mate. I wish you all the luck with that. You mentioned bonds. We are getting back into that 3.4% mark after our little wander below. Michael, quickly, just on yields and US yields in particular, have they gone too far? I mean, we've talked about on this show about financial conditions and the fact they seem to have weakened in the US and how that affects the transmission of policy, as they call it. We look at something like the 2-year yields as a rough guide of where the ceiling may come in for Fed rates, and it's nearly down at 4% when the Fed's expected to be hiking to 5.25. Do you think the market's gone too pivoty over the Fed?
Yeah, it's an interesting one, isn't it? Actually, you mentioned financial conditions. I was looking at this earlier in the week. I've just brought the chart up in front of me now, which I appreciate isn't particularly helpful because no one can see it, but I'll explain what I'm looking at.
Do you want to share it?
Which is oh, here we go. I'll talk you through it. It will only take a second.
Yeah,
effectively, what you can look at is if you plot the Fed funds rate against US financial conditions, it tells quite an interesting story because generally you'd expect as rates rise, financial conditions would tighten, and as rates come lower, financial conditions would loosen. That's generally how the economy works, and as you say, how policy is transmitted into the economy. Something changed after the November Fed meeting at the start of November last year, because since then the Fed have raised rates by 75 basis points at the November meeting and by 50 basis points at the December meeting. So 125 basis points worth of hikes. The interesting thing is that since that meeting, financial conditions have just been loosening nonstop, a one-way traffic in terms of looser and looser financial conditions, both into the tail end of 2022 and also at the start of this year as well. And I think there's two things that are interesting about this. One is the fact that quite clearly the market is not buying the rhetoric that we're getting from the Fed. The market is this idea of higher for longer, which Chair Powell and every other Fed speaker keeps talking about. The market is just not taking that with any sort of seriousness. But the second and the more interesting thing from my point of view is actually we haven't seen that much in the way of significant pushback from FOMC officials, be they voters or non-voters, on this loosening in financial conditions. You would expect that they would be looking to restore that correlation between conditions and the interest rate, but they don't really seem to be showing much desire to do that at the moment. And if that's the case, and if I would highly expect Chair Powell to be asked about this at the press conference on the 1st of Feb. If we don't get pushback on the idea of this sort of decoupling, if there's no attempt to make those two recouple at the next FOMC meeting, then I don't really see any reason why the bond bulls can't remain in control of things and yields can head lower, because you've got a market that's pricing a significant degree of rate cuts later this year, which personally I don't think will be delivered, but the Fed will probably look to loosen policy in 2024. So that affects the 2-year, of course, over that tenor. Growth is slowing, and activity data out of the States is actually been pretty dismal so far this year, and also inflation has peaked. So I do think that bonds could have more room to rally as the year goes on.
Yep, good stuff, mate. I think you get a good point there, and I guess we're going to find out in just over 2 weeks, or just under 2 weeks, and I think it's the 31st, the next FOMC.
Yes,
and we'll get
and
chapter.
Of course, if if bonds do keep rallying, then that's good news for precious metals, particularly if real yields keep moving in the same direction as well.
Yep, exactly. And that'll be music to Stell's ears, no doubt.
Oh, yeah.
Indeed.
Cool. Okay, well, just before we wrap it up, I just want to bring to your attention once again that there is a special offer going on the ForexAnalytix platform, some big discounts going on there. You could almost call them deflationary prices on those there. So if you want to take advantage of that, they're not going to last forever. 27th, we pulled the plug on it. So if you want to get in there, please do so. Once again, I shall pop the link into the old Chitty chat box.
It's a 40% discount on the annual, so that's really good. 30% on the 30% on the semi-annual, and buy 1 month, get 1 month free on the monthly. And remember, you are grandfathered into these prices if you do take advantage of them, as long as the subscription is active.
Yeah, exactly. So you keep those prices, don't ramp them up 80% 2 months after you take the deal. That's not the way we like to do things over here.
We only do that to Ryan.
Yeah, oh, tell me about it. Tell me about it. Inflation. I need to be my own central bank and print my own money. Anyway, pipe dreams. That's it for today. That's it for this week. I shall pass my thanks to K-Man, obviously, who's not here today. Big thanks, as always, to Stelios for his valued input as well. And thank you for Michael for popping up today as well. Look forward to seeing you next week for the other show. And
yeah, and I'm looking forward to seeing you both in a couple of weeks' time, right?
Yes, and
of course.
our shindig together. So yeah, you're going to the theatre first, aren't you?
Yes, and then I'll be buying drinks.
And then you'll be buying drinks. Yeah, well, we might be in by the time you get there, mate. But yeah. And that invitation is open to any of you lads and lassies who watch the show in the UK, in London. If you want to come and meet us, we'll let you know where we're going to be. Feel free to pop along, share a beer, share a story, put some faces to the names, and meet people in person. Not enough done over the last few years in that format because of COVID and whatnot. So nice to get back on that train. Yeah. So thank you guys, and also thank you to the viewers who support us in this show, make it what it is. I hope we continue to give you good content. Please have a great rest of the day, rest of the week. Don't blow your pips on the final day. If you're up, switch it off. Go and have a beer. Go and have a drink. Go and do something interesting, and save your pips for next week. Thank you, everyone. Have a great weekend.
Thanks, guys. Thanks, everybody.
Cheers, gents.
Cheers. Hi traders, I'm Ryan Littlestone of ForexAnalytix and Forex Flow Live, and I'm here to introduce you to the Flow Show. Every day in the UK European morning session, we run the Flow Show, bring you all the latest market news, data moves and events. We make sure that you're informed about what's happening and what's to come that week and each day. What makes us different is that we bring clarity to the fundamentals. We tell you what a central bank comment or piece of data might mean for the price moves and trends you see every day. By nature, I'm a fundamental trader, so I need to know this information myself, and it's what I look at every day to shape my trading decisions. And now I want to share that with you to make it easier for you to understand them and help you learn how they can affect markets. It's not just about me listing out numbers and headlines. We analyse whether there are trends that will change or develop from certain data points, or whether a central banker said something that might change the path of monetary policy and thus prices. We don't stop at the fundamentals though. The fundamentals are just the start of my trading strategies. They create the idea for trades, but then I have to look at the charts to find the levels I'm willing to trade those ideas at. And so that's a big part of the show also. We delve into the charts to look at the tech and how they may help us either plan new trades or to manage current trades. We like to vary from the script too, and sometimes we will have a show that's purely focused on something like trading psychology. Or we may have some special guests on. You just never know who or what might pop up on the show. But that's not all. This show may have my name tag on it, but it's really not about me. It's about you. And so I want to get your input, hear your views, get your questions about all aspects of trading. If you have questions about the fundamentals, the technicals, about learning to trade better, or you simply have a question on what a particular pair asset might do, feel free to come and join the rest of the Flow Show community in asking these questions live in our chat function. So if you're just a technical trader, we've got you covered. If you're a fundamental trader, we have you covered too. If you want to learn how to improve as a trader, well, we have that covered also. Our show brings you the information in a way that's easy for all to understand and act on. So I look forward to seeing you each and every morning on The Flow Show. Trade well and be lucky.